September is likely when the Fed's going to begin the cutting cycle. Still in the camp of expecting 2 rate cuts this year, so September and December most likely. Definitely, I was listening to your colleague from Bloomberg earlier that was talking about the data and what the Fed's looking at. Obviously, if the unemployment picture worsens significantly, much more than what the Fed or the market has expected up until now, I think you can expect the market to price in more than 2 cuts. But I think what the market's pricing in now, around 2, seems absolutely fair to us. And I think they start in September.
Does that happen? So what happens to the curve in that point in terms of the steepener? Do we get a steepener finally that's sustainable? And is it the front end that really comes down, or is it the back end that gets hit harder?
Yeah, so we've been talking about this for a while, that, there's such attractive income in the fixed income markets right now. You can get this diversified income at 6% or over that with a whole host of fixed income securities. But where you source that duration is important. And we've been on the camp that you want to source that in the belly of the curve for now, expecting the curve to steepen out. We've seen a little bit of that steepening, of course, but I would imagine as there is more concerns around the fiscal deficit, or if there's more concerns around, just the amount of supply that's coming into the market, I think we can certainly see bouts of steepening. And eventually, for us to get a lot more positive on the very long end of the yield curve, we'd have to see a positive term premium return to the market. For now, if you can clip 6% or so quality high coupon in the fixed income market with, we like owning investments such as BlackRock Income ETF. Why not do that and clip that coupon?
I am curious, though, on the term premium side, Gargi. I mean, how much of that is sort of still correlated with what the Fed is doing or may do, I should say? Or are there other factors here that have driven that premium to where it is? Or lack of it?
Yeah, so, historically, absolutely. It's a great point. Historically, when we think about what drives different parts of the yield curve, obviously you have your growth and policy and all of that driving sort of the very front end. Then you have other factors that drive the very long end. So if you're looking at anything that's 10 plus, obviously it's growth and inflation too, but you do have concerns around supply, concerns around deficit, which is why investors will demand a higher return. And you're not getting that right now. Right now, why would you, stick around for another extra 25 years while getting less yield for those extra 25 years? So I think a lot of this is on valuations, and the drivers of the long end are related to demand supply and deficits like we talked about, which are all pointing to a little bit of a steepener further from here.